Good afternoon, everyone. Thank you very much for joining and welcome to today's presentation and Q&A with HarbourVest Global Private Equity. We've got Richard Hickman from the managers with us today. But before we get going on the presentation, I'd like to highlight that there'll be a Q&A session at the end. Please do submit questions if you have them as you go along in the box at the bottom right-hand corner of the screen. There's a little square box with a question on it. I can then address them to Richard and try and link any similar ones together. There will be a recording of the presentation available online shortly after it finishes, and in the case, as is the case for last week's roundtable webinar, where Richard and the managers of two other private equity trusts discuss the prospects for a recovery in private equity NAVs and share prices. So without further ado, I'll hand over to Richard.
Yeah, thanks, Billy, and thank you very much to everyone who's tuned in. Really appreciate your time today. So, as Billy said, I'm the manager of HarbourVest Global Private Equity Limited, which is a London-listed investment company. For those who dialed into the round table, hopefully you've had a bit of a flavour as to what we do, but I can remind those who perhaps didn't have a chance to dial in there. We are a very diversified global listed private equity fund with net assets just over $4 billion. We have more than 1,000 private company exposures in the portfolio across the US, Europe, and Asia, encompassing every investment stage within private markets. So everything from seed venture, where we are backing through our underlying venture managers that we work with. We're backing very immature companies that perhaps only have started recently. We're also backing the more mature venture companies, so those that already have significant revenue and still have a real growth runway ahead. We then include growth equity, where we're investing in ultimately profitable businesses, a little bit more mature, but still have strong potential. And then the bulk of the portfolio actually is in buyout investments, more mature companies where the underlying managers that we're backing are taking majority stakes in those companies and kind of running them for further growth and margin improvement. So right across the spectrum of private equity, our portfolio kind of provides that access for public market investors. We're a FTSE 250 constituent, have been for more than a decade now, and we're kind of closing in on the top of that index with a market cap of 2.2 billion sterling. We also have very good liquidity in the shares, so typically £3 to £4 million a day of trading in the stock. Our performance has been strong over 10 years. We have delivered at the share price level in sterling nearly 260% growth. So a 3.6 times return effectively on opening investment for those shareholders who've been with us for that length of time. Over 5 years, the figure is a little bit weaker, of course, given the shorter time frame, but still strong. We've seen the share price rise to around £32 from circa 20 5 years ago. The compound annual NAV per share growth clearly is the bedrock of that share price performance. There's no direct link on a day-to-day basis, but over the long run, the share price does tend to follow, imperfectly, but tends to follow, of course, the NAV per share. So that figure in US dollars is 13.1% per year compounded over that 10 years. So that's net of all costs, of course, through the structure and at the investment company level. So that is the real result that we're delivering in the portfolio. And despite this strong performance, the discount remains wide. As of the date of the presentation, 29%, but we've narrowed somewhat in recent weeks. So we're now at about 25%, but still wider than certainly we would like. And we have launched some initiatives to help close that over time, which I can talk through as we go. So a few words on HarbourVest as manager to set the scene for those who may not be familiar. The manager is a global firm with more than 40 years experience, solely investing in private markets. We're a specialist firm in that respect. We have a stable team. Our MDs typically have 25 years or more industry experience, and have been with the firm for an average of 13 years. We have 15 offices around the world. We have AUM, north of $150 billion and commitments of 180. So we're managing, capital on behalf of institutional investors, family offices, wealth managers, and of course, through HVPE, we're managing capital on behalf of individuals as well. We do have a deep level of expertise across the market, so it's broad and deep. We invest in primary funds, so effectively HarbourVest in most cases is a fund of funds manager. We are partnering with other private equity firms to deploy capital either via their funds, which we call primary investing, through purchases of those funds at a more mature stage, which we call secondary investing, and often through a partnership with those managers to invest directly in some of their operating companies that they are investing in. So we have three main routes as a firm to access private companies, and all three of those are represented in the listed funds portfolio. We're an independent private firm, so accountable to limited partners, i.e. the clients, including HVPE, of course. And we have unrivaled access to data and information on the industry. We have a database with tens of thousands of private companies. We're tracking their key metrics so that we have really good visibility into the portfolios that we're investing in. So a brief word for those who might be newer to private markets and private equity. Why should investors consider private equity, particularly when public markets, led by the US, have performed so strongly? One of the key arguments here is that more and more companies are staying private for longer, and indeed are being taken private in many cases from public market exchanges. So the chart on the left shows the kind of proportion, just for the US now, of companies that are PE backed versus listed companies, just by kind of number of investable businesses. And back in 2010, it was an 80-20 split in favor of listed. Now it's actually shifted to be more of a majority in private hands, in private equity. So there's more of an imperative really for investors who want broad exposure to the growing companies of tomorrow to consider private markets portfolios. And the middle chart shows this in a slightly different way, kind of the number of listed companies in total in the US over time having diminished considerably from 2000, when there were around 7,000 companies, to the most recent figure we have, just over 4,000 companies. So there's been that kind of secular de-equitization in public markets, but at the same time, private equity has grown, as you can see by the orange line, the number of PE-backed companies moving considerably higher over that period. And even with strength in public markets, global private equity on average has outperformed global public markets over the 10 years ending 2024. So there's real incentive, I think, for investors to consider private markets portfolios, and of course HVPE being a representative of the industry. So to put some meat on the bone, so to speak, we have within our portfolio over the years backed a number of household name companies. Of course, when we originally backed these businesses, they perhaps weren't very well known. They were privately held. And so through the venture managers that we partner with, we backed the likes of PayPal and Google and Netflix, those kind of older businesses that IPO'd a long time ago. But also, more recently, the likes of Spotify, Coinbase, Snowflake on the right-hand side of the slide. And we continue to back exciting venture companies that perhaps are not well known today, but may emerge as the giants of tomorrow in their respective industries. So, there's real potential in our portfolios. We continue to commit to venture funds and gain access to some of these opportunities. And a really important point is, whereas 20 years ago, private businesses backed by venture capital would seek to IPO really as quickly as they could to access all the capital and the reputational benefits of being publicly listed. more recently, we've seen a trend for these companies to remain in private hands for 10 plus years before going public. Uber being the most well-known example of that was 11 years between venture capital backing and IPO. So we're seeing that more and more within our portfolio. There are large private companies that still may eventually IPO, and we have some near-term candidates. But frankly, there's less of a need for them to do so. They can remain private for longer today. A top-down portfolio picture here. I thought it'd be helpful to clarify. We do have a series of targets by investment stage, as I referred to before, the kind of level of maturity of the underlying companies. By strategy, i.e. how we access those companies, the structure that we use and the timing, and by geography, which is self-explanatory. So we have a target of 55% of NAV in buyout investments. We're slightly ahead of that at 61%, although recent steps we've taken will enable us to get a bit closer to the target. Venture and growth equity, an important part of our portfolio, but not the dominant part. It's the one that gets the most attention and where many of the companies are household names, but nonetheless, it is not the majority of our portfolio. And private credit and infrastructure, 15% target. We're some way below that at the moment. That is intended to help stabilize the NAV per share over the long run and provide regular cash flows, which help us manage the closed-end fund. So by strategy, primary funds, where we are backing new funds raised by a host of top-performing general partners like KKR, Carlyle, EQT on the buyout side, Index Ventures, Accel Partners, Andreessen Horowitz on the venture side. That makes up half of our NAV, and we're bang on target level there. So to give a brief overview, we are spending a lot of time as a firm continually evaluating the general partners that we work with, clearly looking at their track records, ensuring performance remains on target. But also there are lots of other steps that we take as a firm to maximize the opportunity there. We're looking at new managers, emerging managers. We're constantly evaluating the non-quantitative aspects as well of those management teams, succession planning, progression of individuals, and so on. So it's a relationship-driven business where we have access to some of the real top-performing groups that, frankly, in many cases, do not need new capital to the extent that perhaps less well-established managers might. And so we have a privileged position as a firm where we've been backing some of these groups for 30 plus years, and we have reasonable certainty of an allocation to their next fund. In terms of secondary exposure, we have a target of 30%. Secondary purchases of some of those same funds at a more mature level, 5 or more years down the line, gives us an opportunity to achieve greater diversification in the portfolio. So we can buy assets that were originally invested in, perhaps 5, 6, 7, or 8 years ago, often at a discount to their current value. So there are frequently discounts available in secondary deals, an average of around 10% in buyout investments and perhaps 20 or more % in venture. So we can add value by selectively purchasing some of those portfolios. And finally, the direct co-investment allocation is 20%. That is where, as a reminder, we're partnering with some of those same groups that I mentioned, investing directly into the businesses, cutting out a layer of management, a layer of fees there as well. So that can be beneficial to clients, including the listed fund. Finally, the geography allocation. We try to balance the opportunity set in each region with clearly the risk level, and we factor in a number of macro themes here, but also the private markets penetration in each region, of course, is relevant to our allocation. So North America has been and probably will for some time to come be the largest allocation by some margin. Although I should stress we're technically now underweight the public market indices. The global indices are typically 70% US. So we are a little bit more diversified than a typical public market index. In particular, our Europe exposure is favorable, I think, at the moment. We've had very strong performance from the European funds. The target there is 24% of NAV, and we're slightly behind, so we'll be making more commitments to Europe. And Asia Pacific, still an important part of the portfolio, 16% of NAV, with a bit of a shift internally within that region, away from China to perhaps some newer, faster growing areas such as Southeast Asia. So we're seeing within that regional allocation some tactical shifts in terms of geographical exposure. The industry exposure is not something we are able to control from a top-down perspective, but we show this for full disclosure. And we do have an overweight to technology and software at 34% of our NAV, driven by that venture and growth allocation that we maintain. So important to note in our portfolio that there is that kind of predominance of tech and software across the individual companies, but that is balanced, of course, by a number of other more traditional sectors, which are all significant as well. So it gives a broad exposure across the key industries that private markets really encompass. So now a little bit more flavor in terms of bringing this up to date with the largest 25 current portfolio companies. And we derive these figures on a full look-through basis. So whether we have primary, secondary, or direct exposure, and sometimes we have all three, indicated by the coloured squares in the third column from the left. We're aggregating all of that to give you a full look-through in the same way that an investment company holding listed stock is able to give you that kind of straightforward top 25 list. So you'll see immediately that the portfolio is very well diversified. There's no dominant single company by a long way, the largest being Figma at 1.7% of NAV. So the company-specific risk in our portfolio is very limited. Of course, the flip side to that is that no individual company really is going to move the needle to a significant degree in terms of NAV per share. We're investing in funds and across themes rather than really focusing on individual companies in our strategy. But nonetheless, you can see that in aggregate, there are some extremely exciting names in the top 25 here, and the themes that play out across the portfolio, we expect to drive really strong growth. So I'm limited in time in this session, but I can touch on some of these companies and just to clarify that the green shading, if you're wondering why that is kind of selectively applied, that denotes a company that either is going through a liquidity event, such as an IPO or a sale to another business, or a sponsor to sponsor, i.e. a kind of sale from one PE manager to another, or it denotes an imminent liquidity event that is publicly known. So I'll just touch on a couple of these. Figma actually has already IPO'd. It is publicly listed now, but we've been backing that for a number of years as a private business. The IPO was very successful, albeit the share price has edged down since. Figma is effectively a graphic design service that allows cloud-based collaboration for designers to kind of share ideas. So it's almost like a PDF for graphics. And that utilizes AI, incidentally, in its business model, hence the popularity as an IPO candidate. Shein is a global fashion business, online fashion manufacturer and distributor. It's probably one of the more well-known names in the portfolio. It's been an extremely strong performer. It grew out of a secondary portfolio that we purchased back in 2017, back when Shein was a much smaller business, and it wasn't the dominant name in that portfolio at the time, but it's grown into our second largest holding. Again, maybe IPOing in the near term. I'll focus on Wiz. That is a cloud infrastructure security business, which is the subject of a takeover by Google, yet to be formally signed off by the regulator, but I think hopefully that will go through. Frenary, perhaps a more traditional story, that is a buyout-backed ice cream and frozen food manufacturer based in the UK, second largest manufacturer of ice cream in Europe, and it owns the Häagen-Dazs brand as one example. That is going through a private transaction that will liberate some cash for HVP and other investors. Databricks is an enterprise data management business that is also rolling out AI as a key part of its business model. So it manages an organization's data in the cloud and offers AI agents that therefore then can use that data to serve the purposes of the client. So it's generating now more than $1 billion a year of revenue from those AI agents being being well received by its clients. So a real kind of concrete story of technology business doing very well, and that is rumored to be preparing to IPO perhaps this year. Revolut, very well known in the UK, a private company still, albeit one of the largest in terms of valuation, and again may choose to IPO. It's growing very strongly. It's broadening its range of offerings in the financial services space. And so that's another exciting story from our private portfolio. And perhaps I'll stop there, but you can see further down the list, there's a real mix of assets here that I've focused on perhaps the better known names and those where we have liquidity events coming along. But there are some traditional industrial businesses. There are some infrastructure names here. There are consumer businesses in traditional sectors. So there's very little kind of internal correlation in the top 25 names, giving us a little bit more defensiveness if a given sector or a given theme, falls by the wayside in the years ahead. So we've got a good level of protection there. A note on realizations, because I think those who may have done some research into listed PE or who've followed us for some time will be well aware of the challenge of the discount and perhaps a degree of skepticism among investors over the NAVs that we publish. And that's not specific to HVPE. That's more of an industry challenge in terms of ensuring investors are comfortable with the process of evaluation and with the figures. But one key metric that I think helps reassure many of our shareholders is the realized uplift percentage that we report on a semi-annual basis. And that is showing you when a portfolio company is realized or goes through some kind of liquidity event, the valuation at which that typically occurs represents a material premium over the valuation at which we were holding that business prior to the liquidity event. So, for example, if a business is held at a value of $10 million in our book and eventually sells or transacts at a $15 million valuation, that's a 50% uplift, and that's what we're showing in this slide in aggregate each year going back to 2012. And you'll see immediately, clearly there have been spikes and dips, but the average over all that time, weighted by the value realized, is 51%. So, really strong premiums achieved when our portfolio companies actually are sold or transact. So that shows, I think, our net asset value has tended to be on the conservative side. Of course, there are no guarantees in the future on this, but the pattern, is hopefully reassuring. And even in recent times, there's been a little bit of pressure, as you can see, 2023 and 24 at the low end of the historical range, but still, we saw premiums in aggregate, and if anything, they're starting to rebound. As you can see, the first half of our current financial year, the figure was 53%. And I mentioned at the beginning, we put in place some initiatives to help narrow the discount, hopefully over time. A key measure there is the first of the three here, which is the distribution pool. That is effectively an allocation that we make from the cash that comes in from portfolio companies that are being sold, however that's effected, whether it's natural or through a secondary sale. And we doubled the allocation percentage from 15 to 30% as of January 2025. So what that means is any cash coming into the fund on a gross basis, we simply set aside 30% of that cash into a notional pool, which the board then utilizes for the benefit of shareholders. And so we deliberately kept the structure, flexible there. So at the moment and historically, the board has chosen to use this for share buybacks. And so we're regularly in the market buying shares, and that's clearly accretive to NAV per share for the continuing holders, as well as providing liquidity for those who want to sell. But that doesn't rule out other uses of the cash. For example, if shareholders tell us that they prefer a dividend at some point in the future, that is accommodated within the structure, so the board is able to do that. And so at the moment, I think buybacks are the preferred route, but we're continually in dialogue with shareholders over the best way to deploy that pool. We've simplified our investment structure. I don't have time to go into that in detail right now in the presentation. Happy to answer questions, but essentially we are investing more directly. So rather than going through HarbourVest products as we did formerly, we now have a separate account where HarbourVest tailors the new investment selection to our own requirements as a listed fund. So we set certain targets at the beginning of the year, and HarbourVest then provides us with the opportunities that kind of fit into that top-down allocation. And finally, we have a continuation vote that is going to be held at the next AGM in July. That, of course, gives shareholders a real voice, say in the future of the company. So it'll be a straightforward, ordinary resolution, 50% majority required to pass, and it'll be a positive question. So would shareholders like the vehicle to continue in its current form, yes or no? And so that really, it's a first for our sub-segment. So the listed fund of funds in private equity, we're the only fund to have a continuation vote. And so we feel that represents best-in-class corporate governance going forward. And then to end, my prepared remarks, and I'm happy to go into Q&A shortly. I think HVP is well positioned as we stand today. Private equity has had a challenging, 3 to 4 year period. I think most viewers will be aware of that. I mean, it's been difficult to exit some of the portfolio investments. So the cash coming into the fund has been perhaps less than we would have expected. But nonetheless, we're well positioned. We have a very large credit line. We have a strong balance sheet. We have a well-diversified portfolio, a very good track record, in absolute terms, relative to our benchmark and also relative to our peers. And we do believe that we can deliver on our promise to outperform public markets, by a material level over the long term. So I think there's real value here. Hopefully, many of you might be motivated to look into this a little bit further. So happy to go into questions if we have any.
Fantastic. Thank you, Richard. That was absolutely. One interesting question. Obviously, you mentioned that part of the portfolio is invested into infrastructure, and obviously a lot of the top 20 holdings that you're talking about are obviously exciting companies that are growing crazily. Infrastructure has been actually, I know from our previous conversations, that infrastructure has been actually quite a strong performer or contributor to returns over the last few years, and that's probably why it's there. Can you tell us more about the strategy in the infrastructure space that HarbourVest and that employs, and also, is HarbourVest well known for infrastructure investing?
Sure, happy to. So we focus on investing in infrastructure through secondary transactions, which is an important differentiator because there is kind of ample capital on the primary side. So for new investments, there are clearly sovereign wealth funds and pension funds that are very active in that space. But when it comes to secondary investing, that is a more specialized area of the market. There is less competition. There's a scarcity of capital, frankly, in infrastructure secondaries. So we have a team within HarbourVest, which now has more than a 10-year track record in the firm, and the individuals actually go back, some way before that, of course, in their careers. So we now are a very well-respected participant in that market. We focus on the core and core plus infrastructure assets. We've increasingly moved into data centers and the digital rollout kind of beneficiaries, which I'm sure many viewers will be familiar with as a theme. But we also have traditional assets. So we have toll roads, we have airport terminals, we have seaports, and energy as well, renewable energy in the portfolio. So it's a very well-constructed selection of assets that do throw off a cash yield and of course offer some protection from inflationary pressures and can benefit from those dynamics.
Fantastic, thank you, Richard. How are valuation uplifts on realizations shared between shareholders, partners, and employees? I suppose that's actually a question on what your fees are or how the whole thing works.
Yeah, sure. It's a great question. So the uplifts that we show are gross, so that's before the fees and the carried interest are taken on those investments. And the reason for that is they're all different. So to compare them like for like, we show the gross number. But the question is right. We of course do have a management fee on HVP as a listed fund, which is 0.6% of NAV, so the kind of base management fee. There are costs for running the company, so the OPEX, the credit facility, and so on. At the moment, add about 1% of NAV per year, but that's driven by the borrowing on our credit line, which of course does fluctuate. And then there is carried interest only on the secondary and the direct investments, which typically at the HVP level, because it's only on half the portfolio, tends to range between about 0.4% and 1% per year. What I can't do is kind of deconstruct the realized uplifts to show how much of that is taken, because that varies massively from year to year and from asset to asset. But overall, HVP's total expense ratio is very competitive given our scale and the beneficial fee structure that we have.
Excellent, thank you, Richard. Just scrolling through. So gearing has been moving up. Is this a result of a proactive sort of counter-cyclical strategy, i.e. investing more as the market goes down, and then or something that has just been a function of how of markets?
Yeah, it's more the latter, frankly. It's more cash flow timing in our portfolio. So we maintain a revolving credit facility for the explicit purpose of enabling our board and manager to sustain a steady pace of investment. So what we're trying to do is we're trying to be active every year, building our portfolio, averaging in to each vintage year, because we know over the long term, that's the most reliable way to kind of optimize NAV growth. So in recent years, we've seen negative cash flow driven by the low level of exits in the private equity industry. So that's been the key driver. But to the extent we've been pro-cyclical or anti-cyclical, I'm not sure which, but going against the cycle, we've been very active in buybacks. So the board has deployed now a total of $240 million as of today, kind of over time into share buybacks, which has added 5.5% to the NAV per share. So we've effectively used some of that credit available to go into the market, buy our own shares at sometimes very wide discounts. We were active when the shares were at kind of 45 plus discounts. And so that's been very accretive to NAV per share. And of course, in the long run, will help shareholders because our track record will be so much stronger. So it's a mix of the two, but it's primarily driven by that natural cash flow cycle in the industry.
Fantastic, thank you. And in your review of some of the companies that were hopefully forming up to be sold, you mentioned several sort of AI winners, I suppose. Are there any sort of clear trends within the portfolio about which companies are going to be winning, and are there any that are going to be losing from AI?
Yeah, it's a difficult one, and our investment team, clearly is very active in kind of analysing that dynamic when we make new commitments, and of course the underlying GPs, the underlying managers, that's a key consideration, and they're all looking at their portfolios with that through that lens. I'd say what we've seen as a kind of positive theme is the businesses that were already at the forefront in terms of rolling out new software products, new applications, have harnessed AI to deliver a further competitive advantage. So, we're seeing an accelerated rollout of new products and services. We're also seeing perhaps some of the more traditional businesses, so the providers of accounting software, tax services, those kind of less glamorous areas of the technology market, they're embracing AI to kind of really turbocharge their growth and also to control costs. So those companies, to the extent that they're on the front foot, are benefiting. But of course, in the competitive landscape, there will be losers who are perhaps slower to adopt those new tools, the more traditional providers. So we're absolutely alive to that risk. I would say so far we're seeing more positive than negative in our portfolio, because private equity, and particularly on the venture side, we're backing emerging disruptive businesses more than we're backing perhaps the kind of incumbents, that may already be the large listed companies. So I think private equity as a whole is well placed to be a net beneficiary of AI.
Fantastic. A couple more questions. So venture is clearly making a bit of a comeback, having had a relatively quieter period over the last couple of years. Is the board considering upping their weighting here?
So it's a great question. I mean, we do continually evaluate our allocations, and we have an annual kind of formal meeting with the board where we recommend any changes to the top-down targets. We decided to keep venture unchanged in the most recent review. And I think that's because really we're content with 30% being the optimal level right now. I think kind of chasing an allocation higher today may result in greater volatility in NAV in the long run. And as a listed fund, we're very mindful that volatility is not attractive to our investors. I think it's a real problem. I think the public market is unforgiving of negative years in terms of NAV per share growth, and we've been very resilient, right through the last few years. Our worst year was a negative 1.1% performance. Every other year has been positive. So I think that's been helpful in reassuring investors that we're managing risk, that this is a well-diversified portfolio. And I think more venture would result in more volatility. So I think we're content with 30%. We're already at the higher end of our peer group in terms of our allocation. So I think we're comfortable where we are.
Fantastic. There's the question. Oh, we're looking at slide 10. Sorry, the slide apparently it shows outperformance. Here we go. Yeah, of 1.1% per annum versus public markets over the last 10 years. And so the question is really, what reference index are you using for this benchmark? And can you confirm the start end dates? I guess it's in the small print, which
it is.
I can't read.
Which I can read. I have probably a bigger screen, perhaps, but yes. So the comparator index is the FTSE All World's Total Return Global Index. So with dividends reinvested, with no assumption of fees being taken. So it's a tough benchmark, of course, particularly in recent times. I would say this figure does fluctuate though, because the public markets have been particularly strong in the last 12-18 months. If you went back 2 years, that figure was around 3 percentage points outperformance over the prior 10 years. The period we're looking at here is to the end of November, which is our latest NAV estimate date. So we'll keep rolling that forward. I would be surprised if we didn't see some recovery. We've typically been in the 3 to 5% per year range over a 10-year rolling period. It's just that public markets move much more quickly than private markets in both directions. So we often see a lag in our valuations when public markets have outperformed. It can take some time for that to kind of feed through in the form of IPOs, for example, where we see uplifts, or managers valuing up their holdings, which they can be reluctant to do because they don't want to overpromise and then kind of fail to deliver that value on exit. So private equity, despite its image, I think, is a very conservative industry. The best managers certainly don't want to overpromise, and so you do get these lags. So I'd say that should be borne in mind when looking at the outperformance number.
And just on the sort of performance, have you got any I guess you sort of probably answered it in the panel discussion we had last week. But what gives you sort of conviction that that returns will be improving, and rather than 1.1, you'll go back to the average of 3.3 or 3 or 4% outperformance over public markets?
Yeah, sure. I mean, one key point is our valuations. If we look at our latest sample of the portfolio companies in aggregate, the average EV to EBITDA ratio, so the multiple of earnings essentially, is just under 15 times. And if we look at the global public markets, that figure is closer to 18 times when we adjust for our sector exposures. So that suggests there's quite a significant buffer between where our portfolio is marked and where the public markets are today, and of course the realized uplifts that I mentioned. So I think perhaps hopefully from pure growth in our NAV, but potentially from a combination of growth in our NAV and perhaps a correction in public markets, we are likely to see that figure improve over time. And I think that the root cause of that, the driver of it, is the private equity model being inherently, I think, superior in some ways to the public market model, where the private equity manager is focused on the medium to long term growth in value of the business. There's less short-termism than there is in public markets, and private equity managers are highly incentivized to develop their portfolios and deliver performance for their investors. So I think from a combination of that and as we mentioned, the advantage the industry has in AI benefiting from that rollout, I think it's likely we'll see continued strong performance.
Thank you, Richard. Time for one last question. Talk about incentivization. What's the board and the manager's skin in the game, in inverted commas? Do they own? Is there a disclosed amount of shares that they own, or?
Yes, absolutely. So the board, I forget what the aggregate figure is, but the directors have meaningful personal investments in the shares. It is in our annual report. It's of the order of many hundreds of thousands of dollars. The manager does not disclose its holding. We have significant employee ownership of the shares. There's no particular special discount or deal for employees. There is a restriction, though, inherently on the US employees, where it's very disadvantageous for them to hold HVP shares, unfortunately, and the majority of our employees are in the US. So most of our holders are in the London office and in the Asian offices. So the absolute figure, is significant, but we don't publish that at the moment.
So just actually a follow up on that, just from my perspective, is if you've got employees in Asia or Europe, is HarbourVest seen as a sort of shop window for what HarbourVest does? Because obviously it's hard for a retail investor such as ourselves to understand what HarbourVest is offering other investors. But
yeah, it is. So HVP, the listed fund, often is, I think, seen as a shop window. It's the product that has the most public disclosure in terms of performance, track record, and obviously the kind of latest announcements we make are often monitored by clients of the firm. So I think it's been a very helpful shop window in many ways. The NAV per share performance compounded since the IPO is very strong. We're now more than a 6x on opening assets. So it shows what the firm can do essentially. And the only downside, I think, is the fact that the shares trade at a discount, which is frustrating for the board, for shareholders, of course, and for the manager, because clients who are not familiar with the UK listed market will often assume that might be something specific to HarbourVest as a manager, when in fact the discounts are obviously systemic in the sector. So that is one challenge, I think. But as the firm continues to grow, and particularly in the private wealth space, I think HVP as a listed fund is becoming more important as a shop window, because of course clients that look at evergreen funds on the private side, often reference the listed fund as a kind of realistic expectation of what the firm can deliver.
Fantastic. Well, Richard, thank you very much indeed on behalf of everyone who's dialed in, and thank you all so much for dialing in. That completes our private equity mini series. We've heard from 3 trusts which offer quite different exposures to private company markets, and the investment trust structure really is ideal for managers to provide exposure to these sorts of investments. So I hope we have provided a window into what I would see as amongst the best opportunities available for investors wishing to access these markets around the world. Thank you very much indeed, and don't forget to check the Trust Intelligence website for recordings of these presentations, as well as future updates on the trusts who have presented. So thank you very much.